Okay, let's in this chapter look at another system. Now this system, not one of mine, but the reason I want to put it in is because it's simple, it's straightforward, and it's useful for that reason. Now this is the bow tie system, and you'll see why in a second. Before I get into this image, just want you to remember what we're looking at is the price here, the 10-day moving average, or simple moving average, 20-day exponential moving average, 30-day exponential moving average. That's what these three lines here are. I'll come back to this image in a second. The rules are these. Using the 10-period simple, 20-period exponential, and 30-period exponential moving averages should converge and then spread out again, giving the appearance of a bow tie. At this juncture, moving average should be in the proper uptrend order. That is, 10 is inside the 20 is inside the 30. Just to show you that example, they've converged around here, and then they start fanning out. So you've got them in the proper order, all fanned out. Yeah? Makes sense? The market must make a low less than the prior day's low once that fanning has occurred. You place a buy order above the high of the bar described there. If not filled, you continue to work a buy order above the prior day's high until either it's filled or the low trades below the 20-day exponential moving average. Once filled, you place an initial stop loss below the low described there, and you trail your stop until you're stopped out or exits on whatever other mechanism. It doesn't actually, the exits are not the important thing on this one. So, for instance, with something like this, you've got the proper order here. You've got a low below the previous day's low. Got, therefore, a protective stop in place. You've also got an entry point, which is the high point, and then you see the rally occurring. The exit, depending on how you do it on your trailing stops, might be a 2-day low, or it might be a breach of the exponential, the 20-day moving average, which would be here. As I say, that might be too slow and too lagging, and you might want to go for a 3-day or a 4-day low instead, which in this instance probably also take you out there anyway, but it'll vary. If you're looking for really tight stop losses or take profit levels, then it might be that if the price fails to make a new high and the next day it makes a new low relative to the previous day, you'd get out, and that would get you out somewhere like this point there, which is a lot area. You exit half your position on something like that. So there's lots of varieties there. The important point is the entry point, which in this instance around there, once the bows start happening and it's made a low previous to the previous day, and you enter it at the high point. So as I say, fairly straightforward as a system, and that's really it. Again, we'll try and do some examples of this as we go forward.